Hello everyone, it's Professor Reiko here. So today we are starting our chapter on cash flows and the statement of cash flows. So if you're in the intermediate sequence, this is basically your last chapter. There might be a chapter after this that some teachers cover. I typically in my semester with cash flow statement. And the reason it's last is because you need to know all the other accounting that you've done throughout the year, or even intermediate one and intermediate two, to be able to do a statement of cash flows. And you'll see what I mean when we get to actually doing actual statements. So what we're going to do in this first video is just kind of define the parts of a statement of cash flows and the different methods for doing the statement of cash flows. So this may take a few minutes to get through. But it should cover everything out. The good thing about this chapter is there's no real new accounting. Uh, Basically, it's just another financial statement, a financial statement that you should already be familiar with somewhat between your principles course and even at the beginning of intermediate one when they review the financial statements, they do cover cash flows as well. All right, so basically all the statement of cash flows is doing is this just an explanation for the change in cash, meaning what was cash at the beginning of the year, what is cash at the end of the year, and the difference between that is the answer on my statement of cash flows. So you kind of have a built-in check figure when you're doing one, which does help. All right. It's extremely important. Some would argue that it's the most important for investors and creditors because they're trying to be able to evaluate if a company will continue to produce cash flows. All right. So once again, the ability to generate future cash flows is extremely important when investors and analysts are looking at a company. It helps us tell where we can pay dividends and meet future obligations. It helps us identify the reasons for the difference between the net income and operating cash flows, which you'll see is basically kind of some of the accruals that we do during the year. And then it kind of breaks out the cash and non-cash investing and financing transactions during the year. And we'll get into what that means as well in just a second. All right. So the three sections of a statement of cash flows are the operating, investing, and financing. All right, so let's kind of walk through each of these. Excuse me. The operating section, all right, so I will always just put OCF just to make things shorter, include transactions that enter into the determination of net income. All right, so when you think operating, you think, like income from continuing operations, that's kind of what we're talking about. So operating cash flows are those cash flows that are generated by what we do as a business, by our operations. So as you can expect, if it's based on what we do as a business, having a positive cash flow here is extremely important because it's what we're doing as a business. Is it generating cash? All right, so our inflows include cash receipts from selling goods and providing services. And so that is our main thing. So if you think about it, that's revenue, right? If we sell a good or provide a service, that's sales revenue or service revenue, however you want to call it. And so that's, you can see, comes from our income, our operations, and whatnot. Outflows, there's numerous outflows. All right, so you can just look down here and read through them. Pay employees, pay taxes, pay suppliers, to lenders for interest, all that type of stuff. All of our utility bills, things like that, all going. All right, so the net amount of cash provided or used by operating activities is the key figure in the statement of cash flows, and that's kind of what I've been saying. They always want this to be a positive number, and when we're doing this, all right, so a key way, so if you think about it, there's three sections: operating, investing, and financing. You can rest assured if you have multiple choice questions on your test, there's going to be a question or two that asks you what section does something go into. All right, so I mean, so anytime you see these three, so anytime you have like 3 or 4 things to choose from, it's an easy multiple choice question to ask for a teacher. All right, so an easy way to remember this is if we kind of look at this last sentence here, the operating cash flows is obtained by assessing the income statement along with changes in current assets and current liabilities. All right, so if it's anything from the income statement that we're talking about, that would go in the operating section. And anything that deals with changes in current assets and current liabilities. All right, this will make more sense as we get going and start putting numbers and doing actual problems. All right, but basically what I'm going to do is I'm going to take the balance sheet and break it up. All right, so we have current assets and current liabilities are in the operating section. All right, so that means we still have non-current or long-term assets, long-term liabilities, and our equity that need to go in the other two sections. All right, so this will help us to identify things, because you should know, like, for example, a change in accounts receivable. Accounts receivable is a current asset, therefore it will be handled in the operating section. So that should be something that you should be able to handle now that you're wrapping up intermediate 2. All right, so let's go on to the next page here. Our next section is the investing section. All right, so this is cash flows associated with changes in investments and long-term assets. All right, so this is our long-term assets. All right, so we had current assets on the previous page. We have long-term assets here, so that takes care of our assets. So when you see investing, don't just get confused with investments being there, but think of it also as investing in ourselves. All right, long-term assets, when we buy, those are our capital expenditures. All right, so our inflows include the sale of assets. Notice it says other than inventory, such as our property, plant, and equipment. Okay, so think about cash. When we sell an asset, now we may have gains or losses and whatnot, but when we sell an asset, we have cash coming in the door. All right. Same thing as when we sell bonds or stocks of other companies. We may have a gain or loss, but we typically, but we do have cash coming in the door. And then it says collections on notes receivables with its loans made to others. So you will typically, in the problems you do, you will always see something with property, plant, and equipment. You may see an investment. You're less likely to see that third one. All right, so if our selling a fixed asset is an inflow, then an outflow is obviously the purchase of assets other than inventory. All right, so if we buy investments, buy PP&E, anything like that, and then notice here also that loans made to other entities. All right, so notice here this can be either positive or negative, but it is often negative. Okay, so let's think about that. It says, let's just read on. Because the cash outflow to purchase new assets is more than the cash inflows from the sale of older assets. So think about that. If I'm buying a new piece of equipment for one of my warehouses, all right, so I'm selling an old equipment that's probably out to date. It's been used. We've been depreciating it. It's got some wear and tear on it. So the amount of money that we're going to get for that old piece of equipment is going to be less than the amount of money it's going to take us to go out and purchase a brand new one. Okay, so a lot of times we're going to be a negative number here in this section, the investing section, but don't think of that as necessarily a bad thing. If we're replacing an older piece of equipment with a newer, more efficient piece of equipment, hopefully that's going to lead to better cash flows in the operating section in future years as we're more efficiently run as a company. Okay, so you can see where, it's going to be negative, and that makes sense, but it's not necessarily a bad thing. All right, so our financing section, cash flows associated with changes in long-term liabilities and equity. So there we can see, here's our long-term liability. All right, and that means we're dealing with our creditors. Let's see. All right, people we loan money to. And then equity, so there's our stockholder equity. Anything of that part of the balance sheet goes there. And so this is dealing with transactions with our owners or shareholders. All right, so inflows include issuing stock, all right, and issuing bonds, and then borrowing of money for notes payable. All right, outflows include dividends paid to our stockholders, payments on the debt, and things like that. All right, so notice here, when I said earlier at the beginning of this video, I said you are always going to have to okay, sorry about that. I had a little technical issue there. Yeah, so when you go back and think about everything that we've done during the year, so issuing stock, that was covered in the equity section. Issuing bonds, that was covered in our long-term debt chapter. So all these things affect cash flow, but we had to learn all those first. So that's why we're doing this statement of cash flows at the end of the year. All right, once again, this can be either negative or positive depending on what's going on. All right, so those are our three main sections. All right, there are two ways, all right, to report the operating section. Notice it says investing and financing section are going to be the same regardless of method used. All right, so we have the direct method, which is preferred by FASB, and the indirect method, which most people do. All right, so the way I teach this, and it's a little different than some of the books. And notice here, the operating section will be the same regardless of the method. So it's just two different ways to do the same thing. So I typically teach the direct method first, because there's a shortcut that can be used that makes your life a lot easier when you're doing the statement of cash flows, and it's easier to do it with the direct method. And then I go into the indirect method. But if you're going to have a big problem on the test, if you're only going to have one problem from each chapter, more than likely it's going to be an indirect cash flow problem because that's what's more commonly used. So I typically, when I'm giving a test, my tests are an hour and 15 minutes long. So if you have a longer testing block where it's time set aside, you might have both a direct and indirect cash flow problem. But for me, for time, I will typically test direct method via multiple choice and the indirect method doing a problem and maybe some multiple choice as well. So kind of understand your situation, but the indirect method is the most commonly used format for the statement of cash flow. So that's what you're more than likely to see come test time. But I'm going to start with the direct method, teach a little shortcut, and then we'll go in the indirect method and just basically work a bunch of examples. All right, so that's just kind of our introduction to statement of cash flows. Like I said, no new accounting here. We're just identifying which 3 sections we have, where we're going to put stuff, and now what we're going to do is just start doing it, starting with the direct method. So I hope you enjoyed this. I hope you tune in next time as we get going with the 2 different methods, direct and then indirect following them. All right, I'll see you next time.